Hey, good afternoon, everyone. Jason Vetter here. I am a senior manager inside of our Transaction Advisory Services group, specifically on the advisory and brokerage side. So working with business owners, entrepreneurs, management teams throughout all phases of the process. So finding buyers, negotiating value in terms with buyers, all the way through to closing a transaction.
I'm Carolyn Linkoff. I'm in the firm in Eide Bailey's National Tax Office, and I specialize in the tax side of mergers and acquisitions. I represent both buyers and sellers in all phases of transactions, in all types of transactions, mergers, reorgs, and taxable asset sales and stock deals.
And I'm Kyle Orwick. I'm a partner in our Transaction Advisory Services team. With a particular emphasis on quality of earnings, due diligence, and anything related to accounting of a transaction. We work with buyers during their buy-side due diligence, sellers with their sell-side quality of earnings is where most of our work comes from. We work in all industries, but do a lot of manufacturers, consumer products, industrials, business services, things of that nature, and deal sizes ranging usually from 10 million to 100 million.
Awesome. Well, I think jumping straight into the agenda today, I'm going to start things off for everyone, speaking to the current M&A market conditions. Again, I work a lot with corporate buyers, private equity groups, lenders, have my feet on the street a lot as far as what's going on and what's happening, and want to share my thoughts with you today on what's happening. And right now with the M&A market, I'll have to say, and how we're going to kick things off, to kind of know where you are and where you're going, you have to take a step back and look at where you've been. So I want to kick things off today first, just spending a few minutes talking about 2020. Like everything in this world regarding 2020, M&A was a fairly interesting and abnormal year. And what's particularly fascinating about the M&A market back in 2020 is that every single quarter was unique in its own way. And so starting with the beginning of the year, the first quarter of 2020, things got off to a fairly normal start by many accounts. The big discussion topic amongst buyers, in particular private equity groups, were, hey, it's been more than a decade since the Great Recession of 2008, 2009. We're getting pretty late in this current economic cycle. When's the next recession coming? And that caused some apprehension sometimes amongst transactions we were working on cyclical businesses, construction, things like that, where, hey, this is a fantastic business. You had a great 2019. Right now, it doesn't meet our risk profile. We're a little concerned. And so that was really the only downside theme. Other than that, a lot of investor groups had capital. Corporate buyers were looking to do deals, and it was, by all accounts, shaping up to be an okay year. But we started to see those cracks in the foundation with COVID spreading across the world. And by March, we weren't looking at, hey, is a slowdown coming? Things stopped, right? By the end of March, we were seeing shutdowns across industries, and the world basically stopped. And so M&A activity, once we got to the end of the first quarter and into the second quarter, essentially stopped. I mean, on the corporate buyer side, business owners, probably a lot on this call, we're looking, we don't know what lies in front of us. We're going to conserve cash and see how this storm and these events ultimately unfold here. Private equity groups, that was the same story. I mean, we got to conserve cash for our existing portfolio companies and investments, should they need it. And lenders, as well, as we went into Q2, were saying, okay, we maybe need to stop all new lending activity for M&A and look at our existing portfolio, renegotiate terms with existing clients and investor groups to get in a place where our existing portfolio is in a manageable spot. So, getting into, Q1 overall had fairly normal activity, mostly driven by the first two and a half months of the year. Getting into Q2, really existing activity stopped, save for any deals that were at the 1 yard line. Those, a lot of them by and large, did end up getting closed in the first weeks and month of Q2. But for the most part, a lot of people went pencils down saying, hey, let's see how everything unfolds in April, May, and June. So fast forward then to Q3, a lot of the advice to our clients during Q2 and Q3 as we were working through that process is, if you were impacted by shutdown orders, let's at least wait until we get 2 or 3 months of more normal results back on your P&Ls. It doesn't need to be a full year of performance or anything, but if we can start demonstrating on a monthly basis that results were getting back to normal, we can start to prove out that, hey, from a valuation perspective, we need to look more at the long-term historical performance of the business and not worry about the last 3 months. And so conversations in Q3 started to pick back up. We also started to hear and get phone calls from private equity groups during Q3. And that was an interesting story where we started getting calls from private equity groups who were saying, hey, the PPP money, which a lot of businesses took in April, they used that April, May into June. Are we starting to see any companies that are running short on cash and might need an investment of some kind? We're not trying to be sharks here, but if there can be a win-win scenario where we can get a business ownership in a business at an opportune value while giving owners some liquidity or a bridge to manage the current pandemic, maybe that's a win-win scenario. So we started to see activity pick up. Deals were getting done in that sort of context with private equity groups in the third quarter, although we were not personally involved in those kinds of scenarios. We started to see, we probably hit the bottom and we're working our way up, which led into Q4. And so a lot of groundwork we were relaying with our clients in Q3. We ended up closing transactions in October, November, December of Q4. Activity was definitely getting back to where we were looking for it to be. And there was the election in the fourth quarter, and some buyers had a preference for peace of mind. I want to close my deal by the end of the year. I don't know what 2021 has in store, whether that's from a tax regime standpoint. Carolyn will be speaking to some of those items later in this webinar. But we started to see momentum really start picking up. And so just wanted to lay that foundation for you guys, spend a few minutes there before we really started talking about Q1 and where we are today. So if I were to put that into a visual format for you guys, you see, I'll skip a slide. This is the overall US M&A activity on a quarterly basis for the past couple of years. Over to the right, you see Q1, Q2, Q3, and Q4 of 2020. And you see that story played out, like I mentioned, where Q1, by and large, in most respects, was fairly normal. Q2, we saw that drop. Q3, even more of a drop. And again, I think Q2 was a little higher just from that spillover of deals that were on the 1 yard line. And then you got to Q4 and you saw that big push for deals to get done by the end of the year. And we're at or above historic Q4 levels for most years in recent memory. So very interesting times here with
Hey, Jason,
private. Yep.
you just want to comment on the gray tick mark compared to the yellow bar?
Yes. Yes, thank you, Kyle. So just to clarify, when you see the gray bar on top of the dark blue bar in some of those more recent periods, that is expected activity. Again, reporting comes on a lag a little bit as far as those being compiled. So Q2 and Q3 last year, they're starting to almost get all of that figured out. Q4, there's probably still left to be reported on in databases. So you see a bigger gray bar there. So if you add the blue bar plus the gray bar for Q4, you start to see that be in line with past year's Q4 activity for the most part. There is that spike at the end of 18. But thank you, Kyle. Just to clarify the graph you guys are looking at, the gray is anticipated activity once all of the reporting is in for those most recent quarters. And private equity activity specifically within that previous graphic, breaking their activity out, you see, again, a similar story with Q1, the drop in Q2. But as I mentioned, with those opportunistic investments in Q3, any companies that might have needed a lifeline, you actually saw an uptick in Q3 private equity activity versus on the whole, on the previous slide, there was actually a slight downturn still in Q3 from Q2. And Q4, same thing, big spike. And what's interesting is we do have preliminary data on Q1 this year on the private equity side. And you can see that that blue bar plus the gray expected bars is getting back to that more normal level of activity we'd expect to see in the first quarter of a year. So that's proving pretty well. But again, the numbers aren't quite in yet for Q1 as a whole in these databases. And we're less than 45 days removed from the quarter. So we'll expect to follow that closely and see ultimately where it ends up. But initial indications on what we're seeing in early 2021, you saw that graph in Q1 with things getting back to normal. What are other people saying? You know, reports from Bloomberg and other resources saying that M&A is amongst the highest it's been in a first quarter in a long time, hitting all-time records. Global M&A, US M&A, all of that is looking very strong to start the year. And why is that? What are a couple of reasons? Well, first, we all know the storyline about borrowing costs and the cost of debt. So debt financing in transactions is available now. You know, there was that lull period in the middle of 2020 as lenders were looking at their portfolios, but you know, that activity resumed, favorable rates, that lowers the overall cost of capital for a deal. And so that's helping finance transactions. And so you couple that cheap lending and cheap debt with ample capital that was stockpiled essentially through the middle of 2020 as companies preserved cash, private equity preserved unspent capital. They need to put all that to work now that for many businesses, 2020 turned out pretty well, all things considered, especially the second half of the year. So there's a lot of capital, both on the debt and the equity side right now to finance transactions. And that's what we're seeing right now across the landscape. And not to mention the last point there, SPACs. Now, I'll admit, SPACs aren't the types of transactions we're normally involved with. You see a lot of big headlines with billion-dollar, multi-billion-dollar deals with SPACs in the marketplace and on CNBC and in the news. You know, that's certainly driving things, particularly on the upper end of the market. But it'll be interesting to see how that vehicle evolves over the years and how that influences the M&A landscape. So if we were to first jump, I tried to give you some historic background, what 2020 was like, what 2021 has so far shaped up to be. And we have this first polling question for you guys to see your opinion. We have a survey from some of the top corporate development professionals out there that were asked this same question. When do you think on a broad level, M&A activity is really going to return in the market? And interesting to hear your guys' perspective and share where you think it is, and then we'll see what the survey says. Very good. Yeah, that's if I think, you know, based on Q1 activity, I think it's a fair assessment for what our pollers have considered. And if I were to fast forward that, maybe some caught a glimpse, but it very much reflects the viewpoints shared in that poll. And basically, you know, 80% believe that within the next 12 months, we'll be back to normal as far as M&A activity. And when you look at it again from the debt and equity capital side, there's ample resources right now to do deals. And so it really comes down to, you know, how do we navigate things in a COVID environment? And I think just peeling back the layers of this survey and something for those listening to think about is think about your industry right now. How is the after effects of COVID still affecting your industry. Some, we see it in home building and construction. Those have absolutely boomed over the past 6 to 9 months, where some are still struggling with supply chain issues and other things that hurt their business. Those types of scenarios and situations are going to impact the appetite for M&A across different sectors. So that's something to think about. But by and large, you guys got it right. It looks like in 2021, things are shaping up on multiple fronts to be a very strong year, and plan to continue that into 2022 and beyond. Going to the next one, have another polling question for you guys along the same lines. As far as what is the number one issue or hurdle you think that buyers face in doing deals in 2021? Very good. Yeah, certainly seen some uncertain market conditions. If you're paying attention to the public markets, the past few days, there's nothing more evident than that, with inflation concerns and just supply chain issues. So let's see what the survey said here. Number one actually turned out to be seller valuation expectations, and it seemed to be a very real issue of concern on the buy side. And if I were to peel back the layers of that, I'd say it maybe be unfair to just say seller valuation expectations, the seller's unreasonable or anything like that. I don't think that's a fair assessment here. If I were to unpack that first and top item there on valuation expectations, I'd say, our view of the market right now, typically a lot of deals are valued on that EBITDA times a multiple to come up with a transaction or enterprise value. And from the multiple side of things right now, we're not seeing a lot of difference right now from historical averages. I think, in Q1, a lot of the data is yet to be seen, but we're seeing market multiples fairly in line. There's nothing too crazy on anything spiking or going down. I mean, again, it's a case-by-case basis, and some industries are experiencing a lot of momentum. Q4, especially around COVID-proof businesses, that kind of hot buzzword right now certainly had a premium from the multiple side, but I'd say by and large, the multiples are pretty steady. The big issue, and something for anyone thinking about value for their own business, is the EBITDA side of things, the earnings and the revenue, the business performance. If the multiple's fairly in line, the big question right now becomes off of what level. And again, buyers are buying the future, and they try and look a lot of times at the past for an indication of that future normalized level of EBITDA, which is earnings before interest, depreciation, taxes, amortization, all those fun add backs. And so it's off of what? And we have had businesses where they were shut down in 2020 and the results were down, but we also have others that went through that same thing, but the back half of the year, Q3 and Q4, were so explosive that 2020 overall EBITDA and earnings were up 20% from the year before. And if we look at Q1, that momentum's continuing. And we've had some clients look at it and say, hey, if I annualize the last 9 months and come up with kind of a most recent annualized number, take that times a multiple, is that the value of my business? And I would say, the big thing is, and where that disconnect between buyers and sellers come, is the buyers are all about what's sustainable. What's the long-term value? We're not just buying your business based on the last year or last 6 months or the next 6 months. We're buying it for performance over the, in perpetuity, potentially the next handful of years, etc. And so trying to understand overall where that normalized level is. And so that's looking at backlogs, looking at visibility, whether that's through contracts. Contracts can often have a lot of certainty with them, or as much as you can for months, quarters, years down the road to build that case. And that's where we spend a lot of time with our clients right now, is building the case that current performance is not just a short-term thing. We're seeing trends and momentum that will look to continue for many years. And that's what we're trying to put together and convey. So again, thinking about valuation in current conditions, yes, the market's still uncertain. We're seeing inflation, supply chain issues, but if you can take a step back, assess your own business as far as, what is probably a normalized level of EBITDA for the business right now, if I were to put a buyer hat on, if you're a seller, and just trying to think about those nuances and those implications, I think that will maybe help give you a little bit more truer value versus if you've had an absolute monster couple months here, is that indicative of kind of the long-term growing rate? I don't know, but that's just something for everyone to think about. And then lastly, just want to leave you with some closing thoughts on kind of where we are and where we're going. So we talked about in 2020, in the middle part of the year, a lot of companies preserved cash because we didn't know where the bottom of COVID or how long it was going to last, as well as with private equity. And you see that spike in 2020 as far as non-financial corporate balance sheet cash, so cash available for corporate buyers, as well as private equity dry powder, which is unspent capital that they have available from their investors. Those are at all-time highs and have really accelerated. So again, that whole concept of cash available to invest, it's there. And insofar as, there's industries that make a ton of sense right now to invest in from their different profiles, there's a likelihood that they're going to pursue that. So we are very, bullish on 2021 activity. SPACs, we're seeing the fundraising too, can't count them out. I think we're going to continue to see headlines made from those vehicles and what moves they make inside of the market. But across these factors, coupled with low borrowing costs still at the moment and foreseeable future, those factors are shaping up for a strong M&A market. And another topic we're seeing for this year is the topic of taxes. What could 2022 look like? And so we're seeing and having a lot of discussions with clients who are looking to close a transaction here by the end of the year. It's the middle of May, so we have 7.5 months left, I believe, to close a transaction. So a lot of those discussions are happening now, so that we can have a transaction closed by the end of the year, which tax piece is something, Carolyn, I'm sure we'll dive into here. But that's all I have to share with you right now. It's been a very interesting past 16, 18 months, and we'll definitely see where it's going, but we feel pretty good about where we're at right now as far as M&A activity.
Thanks, Jason. I can definitely attest to Jason's graphics about the pace of Q4 20 deal activity and certainly this past Q1 2021 deal activity from a tax perspective. So first, I thought I would just mention a couple somewhat novel things I've been seeing in the deals from the past 2 quarters. The first one is the reemergence of the right to refund provisions in stock purchase agreements. In stock purchase agreements, historically, there would be provisions saying whether the buyer or the sellers had the benefit of claiming a tax benefit for the target. In other words, could you do a carryback claim? Who would get the benefit? For the prior to COVID, those provisions sort of went silent or went less important because the Tax Reform Act of 2017 eliminated the NOL carryback provisions. Well, fast forward to March 2020, the CARES Act enactment of the NOL, the 5-year NOL carryback, and suddenly every stock purchase agreement I was seeing not only had that provision was very heavily negotiated, which party had the right to the target refund, but it actually saw it kill at least one deal. So we are starting to see that as that becomes relevant again. And related to that is if indeed the seller was lucky enough to get the benefit of that provision in the SPA, often they said, well, gee, I can add to that NOL carryback because I'm going to incur a ton of transaction costs that could be deductible. So I definitely want to make sure I analyze my transaction costs and make sure we add those to our NOL carryback if we're going to do a 2020 NOL carryback claim. The other issue I was seeing, which is you would think is not particularly novel, I think the scope of it though was novel, was employee bonuses. You know, it is not atypical to give employee bonuses when a target is being sold, but I think because sellers were getting such high value for their deals this year, they were feeling very gracious and wanted really to give almost a portion of the deal proceeds, not just a bonus, but almost a portion of the deal proceeds to loyal employees. And the reason why this came up in a sort of in a tax context is, well, if I'm going to want to give an employee a bonus, I certainly want the tax deduction, but usually the seller of the target can't afford or doesn't have the funds to give the employees the bonus until closing when it gets the deal proceeds. But then of course it becomes an after tax deduction, which isn't really appealing to sellers. So this sort of went back and forth, you know, the timing of paying the bonuses, and then if the buyer agrees to pay the bonus, that's a better tax answer. Could be a better tax answer for the seller, but maybe the buyer doesn't want to do that because it goes on the buyer's payroll and then the buyer's employees see this. So it becomes sort of a non-tax issue, but very focused on that area. Another issue coming up a lot was 382. This is always relevant in stock purchase transactions. The reason what made it so novel this year was, you know, the 382 limitation is a product of two factors. One is the federal long-term tax exempt rate, which for the past 5, maybe more years has been pretty low, anywhere from 2 to 3%. And then the other product of the NOL limitation is the value of the target. Well, this year, the long-term exempt rate was lower than usual. It was hovering around 1%, but because targets were being valued so highly, which is unusual when you have a loss corporation, we actually didn't see 382 limitations being that low. So that was kind of unusual this year, and actually reemerged as a seller's negotiating tool. Hey, I've got a target and we have NOLs, and actually they can pretty decently be used going forward. A couple other transactional issues that I've seen that seem, I don't know if they're COVID related or what, but the F reorg has become the transaction du jour. And F reorg has a very similar tax results to a 338H10 election, except that you don't actually have to make an election. It's just that what they do is they're transactions that put the target in a position where the buyer could then do a transaction where the buyer gets asset purchase treatment and therefore gets to amortize or depreciate the cost of its purchase price, step up the basis to fair market value. For some reason, doing it this way, where we do the F reorg versus the 330H10 was very common, I would say, in the past 2 quarters. As is always with F reorgs, there's a couple, not paying a tax issue, but it's a tax issue that can sometimes trip up a deal. It's to make sure that the target can retain its EIN, and typically that's difficult. So you have to do a lot of other transactions. You have to do maybe a formless conversion of the target. You also want to be careful that the target didn't make a previous check the box election within the prior 60 months. that might mess up the F reorg. And if that F reorg is messed up, then the buyer doesn't get to do the transaction that it wanted to. So I saw some footfalls with those. Purchase price allocations, because these transactions are structured as asset deals, you got to do your purchase price allocation. Historically, in a pre-COVID era, I saw it was always that buyer and seller agree in the purchase agreement that they will exchange draft purchase price allocations shortly before closing, so there's no surprises. This year, I saw a lot of situations where the buyer took control and said, I will determine what the purchase price allocation is, and you may not know, seller, until after the closing. So that was a little troubling for me when I was representing sellers, because that's not something we want to be surprised about. And then the other issue that was becoming increasingly common was, while buyers were offering high purchase prices for targets, part of what they were offering was not just cash, but hey, I'm going to give you part of your consideration in equity in me. And then that also becomes a transaction structuring piece, because we have to figure out who's going to get the equity, whether it's going to be the S corporation or the shareholders of the S corporation that are getting the equity in the deal. So what's on everybody's mind, as Jason was talking about, is tax reform. There's always tax reform. If Biden's tax proposals come to fruition, how is that going to impact M&A? Well, so here's the thing. So in the past year or two, the corporate tax rate has been at a terrific rate of 21%. Biden's proposals will take it to 28%. Historically, the shareholders' capital gains rates when they sell their stock has been 20%. Again, under Biden, he's saying we want to take that to 39.6%, which, by the way, does not include the 3.8% Medicare tax. But if you put those things together, in my opinion, that's going to put a total freeze on asset sales, because that will put that's sort of the trifecta of what the version is to C corporations, the double taxation is. And I will illustrate this in the next slide. So if you assume that you have a C corporation and a target, and the buyer says, I'm going to give you some kind of purchase price, in the C corporation, you're going to recognize $20 million of gain. What those increased rates will do is basically drive down the seller's proceeds to less than 50%. So you're going to have the corporate tax be about $5.6 million of its proceeds. And so you take away that from the proceeds. Then the proceeds that the shareholder gets, they're going to pay another probably 5.3, probably a bit more. They're not walking away with a lot. And so I don't really know what's going to happen with asset deals, but I can imagine C corporations are not going to want to do them. So what can people do to either get their asset deals done and or protect against just even not knowing how the rates are going to go? Well, and Jason alluded to this too, is let's get your deals done in 2021. At least you have certainty for what the tax impact will be. The other mitigation strategy is to incorporate in tax indemnification provisions into any transaction that maybe gets closed after 2021. And that type of provision may say, hey, this is what we expect the purchase price to be or what the sales proceeds will be. But if rates increase such that our tax burden is going to be that much more, hey, buyer, you're going to have to indemnify us by that much more. Whether buyers will agree to that, I don't know, but certainly something that can be negotiated. I think stock sellers, because they'll be grateful for buyers who are willing to do stock transactions, may compromise a little bit on the prices they were willing to, or the purchase prices they're willing to get, just to get a little bit better of a tax structure. And then finally, what you can do, which is what we always do, but you're just going to have to map out a lot more scenarios, is just to model obviously your stock versus asset transaction. You're going to model your stock versus asset transaction based on current tax rates, based on Biden's rates, maybe based on, middle of the road rate and whatnot. But there's going to have to be a ton more planning and legwork to know at this point whether you're going to want to do a deal at all. And while tax is always important in a deal, it's going to be a lot bigger portion of a deal, particularly if we're seeing corporations take home in their shareholders so much less in deal proceeds. So that's all I have, and I will now kick it off to Kyle, who has some more to offer on the state of M&A in general.
Perfect. Okay, the difference between a 33H10 and a 336E election is?
Actually, the answer is C. The 336E election is made with a return, not on the Form 8023. And importantly, I was going to talk about this in my slide. The 336E election has to be made on a much quicker timeline than you have to do the 330H10 election. That's it. Thank you for answering that polling question. Now I think back to Kyle.
Thanks, Carolyn. Thanks, Jason. My area of focus is mainly on kind of vetting out the numbers, and Jason alluded to this at the end of his presentation, that kind of really getting a stronghold on what normalized level of earnings are is where we spend 90% of our focus, is to really, the multiple can change between 3 or 4.5 multiple and 5 or 5.5 multiple, but the earnings is the baseline number that everybody also wants to know. So because of over the last 12 months, financials have been askewed. Getting underneath kind of the normalized levels is increasingly important, and there's kind of a heightened amount of diligence that is needed. And in the context of the market right now, we work a lot with investment bankers that are going to market with their clients in the middle market, and I hear a lot that they're telling their clients that unless you start a process in the next month or two, it's going to be really hard to get a deal done by year end. And obviously, it's not to say you can't get a deal done, but the amount of diligence that a seller may want to undertake preemptively on their own business, and then the amount of diligence that a buyer is going to have to undertake to make sure they're underwriting the right amount of EBITDA has kind of heightened and is even more significant than it was a year ago at this time, or 2 years ago at this time. So just kind of wanted to give that kind of overall context as we look to discuss the current market and kind of what we're seeing in for adjustments and things. So, as we think about seller efforts and strategies as they go to market, a lot of times we'll advise in the first month it could be anywhere from a year away from a transaction. It could be anywhere from 6 months away from a transaction, but with the intent of going to market within a month or two. We're trying to go through seller financial statements to understand any kind of one-time events that are impacting earnings. I have some examples, COVID related on the next slide, but just more generally, for sellers, we're looking at kind of any lawsuits, positive or negative, penalties or fines that are impacting the business. What is the net working capital situation of the business? How is that impacting kind of the free cash flow of the business? And is it kind of at a normalized level? And what's the seasonality of that business? So just, those are the two main drivers other than tax that kind of have the biggest impact on proceeds. Is what is the amount of EBITDA and what is kind of the normalized level of working capital that the buyer is going to expect you to leave within the business, as well as what items are kind of debt-like that may be underneath or in current liabilities that the buyer might want you to kind of pay for in advance of closing the transaction. We talk a lot about discretionary expenses in deals and in sell-side processes. In closely held businesses, especially ones that are owned by one person or two people, sometimes there's more personal type nature expenses included in the business. Try to carve those out. There could be, additional people on the payroll that are family members, or maybe they're paying themselves a different rent rate than what a market might show. And then obviously any post-closing adjust or post-close management and technology considerations really kind of enhance the value of the business, kind of professionalizing those. So we just try to walk through those items as we look at the financials for a seller. And then on the buyer side, really vetting out, the sell side quality of earnings and due diligence effort might be in the first of 6 months of a process. The buy side might be in month 3 or month 4. We might be looking at the sell side quality of earnings if there is one. If there's not, we're creating it for the first time to really understand adjusted EBITDA. We might verify what the investment bank has suggested as adjusted EBITDA, kind of vouching down any one-time revenues or expenses that they're trying to normalize, trying to get a stronghold on what their backlog and purchase sales commitments and purchase commitments look like Jason was saying, that really propel the business forward. And then if it's a stock deal, obviously we're trying to coordinate that tax due diligence, or even an asset deal, we might be looking closely at sales tax and other types of tax that might continue on. So those are the kind of the main seller or buyer considerations that we're trying to heighten, and I think is even more important in the situation we're in today. On the next slide, I think I outlined a couple COVID specific items, but more generally, again, this is just a simple EBITDA bridge that shows, the company's reported numbers. They aren't necessarily in compliance with GAAP. They don't have an audit done. So there's a few changes made to add some accruals to get to a GAAP number, as well as maybe a change in accounting policies that are just kind of arbitrarily impacting the financials. If you were sitting there trying to underwrite this deal in May or April of 2017, obviously this is an old chart, but if you were underwriting that deal in May of 2017, you might look at 2016 and say there's 6.8 million of EBITDA. But because of the change in accounting policy that is impacting the financials, as well as, there's another example of a change in the business operations from the sales channel and some royalties that were paid on this deal that are going to now be paid in the current situation, that the earnings of the historicals aren't necessarily reflective of the earnings of the future. So as you go and bridge all the way down for the different type of adjustments, you get a little bit closer to a more flat and normalized level of earnings. So instead of paying on 6.8 million of EBITDA at the top there, we would say that a more normal level of earnings is 5.7. So that's kind of like that's the typical what we were doing all the time before. Now, as we get into the current environment, there's still usually in the financial statements of the current, trailing 12 months or last 12-month period, there's at least 2 to 4 months or 6 months of earnings that can be negatively impacted or positively impacted because of COVID. And some of these, might stick around. Some of the change in, from a retail model or a distributor model to an e-commerce model, some of those might stick around where they've kind of adapted and now do a lot of, sales and webinar trainings and things on their products, and they sell it right on their website. I have a client that had been going through a process to convert a lot of their sales channel into e-commerce, and COVID just extrapolated that really, really quickly for them. So they don't think about the shift in sales channel to be that it's going to go back to that. They think that once the stores are now open and people start going back into stores, that they're going to see a little bit of people turning back to that channel, but they think that they have attracted new customers, and those customers are just at higher margins. So it's been really good for their business. But obviously, if you see like a huge spike in hand sanitizer sales in the financials, that if they had never had sold hand sanitizer before, that's obviously something that might be needed to be carved out. Obviously, if there's any PPP money, PPP gains, those get taken out almost immediately. But there might be some excess payroll, might be some bonuses and things in the financial statements that won't be there going forward, and really we're only there to spend the money. Could be some deficient travel expenses where their sales staff is going to go partially back on the road, but they were able to complete and convert sales during the current period. So there's just all of these changes in the business and in the financials that should be considered and vetted out. We advise that the sellers do it preemptively, and can justify the changes in the business, or the buyers obviously will be doing it during their buy side diligence. Shortages and some examples of some supply shortages. Lumber markets right now are kind of crazy, really crazy. We saw a business that was in the kind of food delivery where, and they used dry ice. There was surcharges there, kind of some excess expenses. So there's just a lot of kind of fluctuation and non-normal activity. So if you're not, you might be adjusting some of these items in the pro forma financials, but at minimum, it should be a good understanding and a deep understanding of what is within and impacting the financials that you're underwriting. So EBITDA is kind of a made up thing. It was kind of funny for a couple months a year ago, but just to showcase in this business, there's a large increase in sales in March, April, May that kind of tapered off, but now you see a large increase in December. And so is that justified in this business? These are monthly financials. The total bar is revenue, and the cost and operating expenses and EBITDA added together. Whether you normalize that off or not is a judgment call, but it should at least be kind of vetted out. And in the good news is for this business, they're going to be well past this by the time they go through a transaction. So at least the buyer will have some certainty that kind of the business will continue on. The bottom graph is just a quick example of one that had some slight disruption, showing their kind of lowest months over the worst months of COVID, when there was some more shutdowns. Just being aware that is kind of still sitting within the annual numbers or the 12-month numbers, but we would expect earnings to come back here in the next few months. And then on working capital, we saw one more example maybe of some situations maybe we would actually normalize revenue is on when we had one client that had some rent deferments and rent cancellations during those first few months when kind of everybody was asking for something, whether it was delayed payments or something kind of reductions. We maybe would add those incremental revenues back because they're now reoccurring customers. They were reoccurring customers. They just wanted something to make sure that they could get through the current situation. But it would, you could reasonably expect that revenue to continue, and the cost structure hadn't changed. They paid the commissions, they paid everything that was required for those contracts. And then here, it's not drastic, but you see a slight dip in, this is a 12-month net working capital chart. You see a slight dip in the average over those first few months, really because payables increased because their vendors allowed them to get, instead of 30-day terms, they got 60-day terms. So we would right size kind of the DPO of that to make sure, you know, the level of net working capital would be better reflected without those kind of unusual situations. So just kind of in recapping, to get kind of deals done and get deals done, you know, we're just advising a heightened amount of diligence either on the sell side or the buy side, because there's just less certainty around the financials. So the more transparency you have and the more times you analyze a different segment, or you're looking at sales channel versus you know, just looking at the overall P&L, you're looking at monthly by sales channel and these trends, what is it going to return to normal? The more diligence that a seller has done preemptively and can better explain their position on an ongoing basis, that we think the better. And obviously on the buy side, just underwriting and making sure, as Jason said, that EBITDA is really vetted out and that things are going to be kind of into the future, that it's reliable. We see some ways that buyers are, you know, or actually sellers, sometimes they're doing maybe a little bit less exclusivity. We have some investment banks that are requiring 3 to 5 parties go through full financial due diligence, QVs, before exclusivity. It's really burdensome on the sellers, but at least there's more certainty to kind of a normal, you know, that the EBITDA numbers and the valuation is going to be held up and propped up if everybody's through their own due diligence and has gone through that more heightened due diligence effort. But we still see retrades going on. We see a little bit more in the earnout phase, longer earnouts. We see some more seller notes and some more rollover equity that buyers are just trying to safeguard themselves some from the downside risk from either heightened amount of earnings or kind of explanation of why the dip and, you know, that it shouldn't be discounted because of the dip, because of COVID. So we just see buyers doing different things to kind of try to safeguard themselves. So with that, you know, we just see that, you know, there's a need for deals. There's just going to be so much activity, I think, in Q3 and Q4, that the earlier people start, the better, in order to try to get a deal done in 2021. But unless you kind of start soon, it's going to be tough to say whether those deals get done. So I'll leave it with that.
And we did have one question come in, and it says, can you elaborate a bit on what multiples you're seeing or expecting to see rather than just that they seem to be rather normal? Does that make sense?
Yeah, absolutely.
Okay.
I'll speak to that for a minute. And it is a very interesting market out there. Again, on the average, using some data, for example, we have a resource that looks at private equity investments and private equity deals with values between 10 million and 250 million. And we track that for private equity activity. And for them, the typical deal range is anywhere from, on multiples, 3.5 times all the way up to 15 times. And on the average, it's in and around 7 times. And the data we had from the beginning of 2020, that average was about 7.1, 7.2. I think there might have been a 7.3 number in between kind of, you know, the first months of 2020 and end of 2019. But anyways, what we're seeing right now in the fourth quarter is that average was right around 7 times. So about a point or two below. However, you know, the caution I have on just throwing out blanket multiples right now is it really depends, given how magnified this market is across different sectors. Retail, especially retail without an e-commerce segment, leisure and hospitality, restaurants, those multiples are a bit depressed right now. So you have that on the bottom end of things. And on the top end of things, we talked about that COVID proof. You know, we sold a business on that higher end. It was about 33% margins. It was a SaaS business. So IT, heavily contract recurring revenue base, which is very attractive to private equity groups right now, just given the visibility. That one sold for about 15 times up on that higher end, which was about 5 times revenue. But for like your average manufacturing business, they're generally in and around that 7 times range. But you have to peel back some of those layers, supply chain issues, things specific to your sector or sub-industry. What are kind of those push and pulls that you're seeing right now, and how that might affect value? And lastly, just on the financial end, let's say you have a business that did $100 of revenue at a 20% margin. So, $20 of earnings. You had another business that was $200 in revenue at a 10% margin. Again, that same $20 of earnings, which one would command a higher multiple? Well, if you look at that next dollar of revenue, the first one I mentioned at that 20% margin is going to net 20 cents on the dollar for that next dollar of revenue, versus that bigger business, same revenue, is only going to get 10 cents. Obviously, that higher margin business is probably going to command, all other things being equal, a higher multiple. So those are things too. What's your profitability relative to your peers in the marketplace? That can be a big driver too. I mean, that best in breed, if you want to call it that, can certainly escalate that multiple, because people want, the cream of the crop. And so that's something also to assess, or that, us or someone else can help you assess on where those multiples might be in the current marketplace. So again, it's a big depends. I know that's an answer no one likes to hear, but again, on the average, we're about there or at that level we were before. Again, it's very situational given how polarizing the market continues to be right now in certain sectors. I guess I would just say, Kyle ended with it. I mentioned it as well. Carolyn too, time is of the essence a little bit. We have 7.5 months till the end of the year. So if you're thinking about doing anything regarding a transaction of any kind, don't hesitate to reach out to your CRE, get with them, get with us, and talk about what that roadmap might be and how we can help, because getting those ducks in a row to execute before 12/31, if that's a part of your plan, we need to get rolling on that.
Perfect. Well, thank you everyone for attending. Thank you, Kyle, Jason, and Carolyn. Have a great day, everyone.